All right, welcome everyone. Thanks to everyone in Bankland for taking the time and tuning in today. We've got another great event in store for you, and I know it'll be entertaining and informative to our viewers. I'm Brian Love, head of depository recruiting here at the Travillian Group. The Travillian Group is a boutique executive recruitment firm serving the financial services space since 1998, and my division specifically covers community banks and credit unions around the country, assisting with expertise around talent acquisition, advisory, and succession planning. We focus primarily on the recruitment and retention of board members, C-suite executives, and important senior players at community banks all over this great country. Please connect with us on LinkedIn, Twitter, or YouTube, and visit www.travilliangroup.com to sign up for our mailing list and learn more about our bank practice and current search engagements. Travillian is also quite proud of its deep national network that includes the best consultants and advisors to community banks. And today, we're very excited to bring together three top investment bankers covering Southwestern financial institutions. Without further ado, I'd love to introduce today's panel. First, we have Chris Murray, Managing Director, Financial Services and Investment Banking at Piper Sandler. Chris advises financial institutions primarily in the Southwest and Midwest regions of the United States on various strategic matters, including mergers and acquisitions and capital raising. Previously, he was a principal in the investment banking group of Sandler O'Neill and Partners LP, and he has more than 30 years of investment banking experience. Live from New Jersey, welcome, Chris.
Thank you, Brian.
You bet. Next up, we have Dan Bass, head of Southwest Region Investment Banking at Performance Trust. Dan joined Performance Trust in 2012, and prior to joining them, Dan was managing director at FBR Capital Markets and Carson Medlin Investment Bankers, where he consistently ranked among the top deal makers in Texas. Live from Houston, Texas, welcome, Dan.
Hello.
How are you?
Good.
And rounding out our panel, we have Kade Machen, managing director at Stephens. Kade joined Stephens in 2015 as a member of the firm's financial institutions group to extend investment banking coverage into the Southwestern U.S. for banks and thrifts. Prior to joining Stephens, he worked as a director for Stern Agee and a VP for KBW, advising bank clients on M&A and capital markets transactions. Live from Dallas, Texas, welcome, Kade.
Thank you, Brian.
You bet. I also have the unique pleasure of presenting my co-moderator, Joe Fenech. Joe, nice to see you.
Thanks a lot, Brian. Appreciate Travillian hosting this event. Afternoon, everyone. I'm Joe Fenech. I'm Chief Investment Officer of GenOp Capital Management and content contributor for the Travillian Group. Along with Brian, I'll be moderating the discussion today. I want to thank Chris, Kade, and Dan for agreeing to participate in the webinar today. And I'm as interested as anyone on the line to hear what they have to say. So why don't we go ahead and get going. We're going to discuss a number of topics on the call today, time permitting. The outlook for M&A and consolidation that our three panelists see for 2021 and beyond is right up at the top of the list. We'll talk the capital markets environment, what we call the new normal environment post-COVID, talent and succession planning, and then the regional outlook for the Southwest and Southwest banks, regulation, and then concluding our talk today with the topic of fintech. So let's start with a very big picture question, if we can, for all of you. The pandemic's still a big concern, obviously. We have a vaccine, but we also have a resurgence of the virus across the country. We're in a political transition process. There's policy uncertainty. Bank stocks have rallied, and we've seen some high-profile merger announcements. Credit seems to be under control, and most banks are well reserved, and the industry has a lot of capital. So is there an M&A, pretty simple question to start off here. Is there an M&A wave ahead? And if so, what impediments in your all's mind loom largest to see in that kickoff? Why don't we start with Chris and then go Dan and then Kade? What are your thoughts, guys?
Well, thank you, Joe and Brian, and appreciate the Travillian Group putting us together for this discussion. So thank you for creating this platform. My view is that I always hear the phrase, "Is there a merger wave coming?" And I think what I think Kade and Dan will agree in is there's definitely going to be more M&A in 2021, bank M&A, than there was in 2020. I mean, in terms of number of deals, we're probably down 60%. If you back out the larger deals, in meaning the SunTrust BB&T and the latest deal with PNC buying BBVA's U.S. operations, we're probably down a corresponding amount on dollar volume as well. So it's hard to imagine that 2021 won't be higher. But I think the real, to go to your question, impediments about it are really where the economy goes. So as you said, Joe, it looks like we have a vaccine. They're talking about the distribution, but I do think that it's really how the economy continues to rebound. Banking is just a leverage bet on the local economies. And so over time, as the economy continues to rebound, look better, and presumably we get a little more steepness in the yield curve, a little higher interest rates, I think the biggest impediment will be where are valuations from a public company going. And I think that will be a direct contributor to more activity in the M&A market in 2021. And I think it'll probably be back end loaded. I think there's clearly discussions happening. There's clearly deals being announced, but I think it's going to take a little more time into 2021 before we see a wave.
Chris, back end loaded in terms of announcements, or they get announced earlier in the year and completed at the end of the year, or back end loaded in terms of the actual, we won't see, the announcements until the second half, you think?
Well, I think we'll see announcements in the first quarter. I just think the volume will pick up as the economy rebounds and as we have more clarity over the rollout of the vaccines that have been said to be effective. So again, I think it's first they deal with the healthcare issue, then we have more certainty over economic, both from a government standpoint and just core business, what's going on there, a little more clarity on credit, a little more outcome on what government policies will be. And I know we're going to get into that probably later. But I think as there's more and more confidence about where we are, I think that will drive CEOs and boards to be more aggressive on the M&A side.
Dan, anything to add to that?
Yeah, I agree with the correlation with the public markets is a big deal. If we continue to move forward from our March lows on the bank stocks, then yeah, that'll help drive volume. I know everything stopped obviously in March, but our pipeline is active again, and we're probably going to announce a couple deals pretty quickly. But I do, when I'm talking to buyers, I want to make sure that they understand that, digging deep in the loan portfolio is a big deal. And I'm telling buyers they want to wait until the potential target has an exam, so the examiner can be the bad guy, not you as the buyer. Once you get some clarity around that portfolio, then I think you will see more activity in 2021.
Guys, do you think it's going to be geographic in terms of like the pace of the recovery in M&A? Like, will it be the hardest hit areas with the high premium guys coming from out of the hardest hit areas to take advantage of a distressed opportunity, or you think the hardest hit areas will be later to see more M&A announcements? What are your thoughts there? Anybody really?
Joe, this is Kade. I've not thought through that one yet. Focused mostly on Texas. I'll just tell you kind of what I'm seeing is definitely a pickup in conversations. I agree with Chris, probably more loaded to the second half of 2021 for announcements. But as far as a wave, look, anytime you take effectively a year time out, you have some natural pent up demand, and that's in the system right now. And it'll work its way through. But the biggest impediment is, in my mind, is valuation. So you talk about the different markets and, higher premium buyer looking at a lower premium seller. It just depends on, I think, where the stocks are or private companies, what their valuation expectations are. But within the Southwest, for this conversation, most of those economies are doing fairly well. They all have effectively the same issues.
Okay. Well, thanks for that, guys. Kade, maybe directing this one to you. Your firm announced an M&A transaction last week. In general, would you say that the conversations and the announcements that we're seeing right now are mostly resumptions of the discussions that were happening pre-COVID, or is what we're seeing emanating from the experience of COVID and these are new discussions that are taking place?
So in general, I think what we've seen announced, it's a very small sample set. As Chris mentioned, the volumes are way down in 2020. But I think I look at it as three buckets. The first bucket, which I feel are the deals that are getting announced now, are the ones that were in conversations with their partner pre-COVID to even perhaps having a signed letter of intent pre-COVID. The second bucket, I think, are those banks that over the last couple of years been considering a sell, and I think this, call it recession, pandemic, complicated times are going to force some of those guys to speed up their plans. And then the third bucket, or just the regular way, it's been another couple of years we look to sell. So from what I've seen it have been announced so far, I'd say outside of the BBVA deal that Chris referenced, would be deals that were kind of pre-COVID, not a distressed type nature. And specifically to the deal you mentioned, we sold National United to Bancorp South. That was announced this week. That was a pre-COVID discussion. Effectively, a pre-COVID deal took a timeout just to watch credit at both companies and let the valuation recover. You saw the market tank in May, as Dan said, 40% for the average bank stock out there. It's recovered, still got another 20+% to go, but a nice recovery. So, I expect there will be more of those that had already picked their partner, and it's now just, wait on timing. As far as, do I think there's new conversations yet, specifically in Texas? Every bank has more stress today than they did have, but I'm not seeing any that are really nervous, or at least now, about a recap scenario that would force them into a sell. Now, as these deferrals continue to burn off and another perhaps slow down, the hospitality industry catches some of them, you might see some banks become sellers that were not sellers pre-COVID. I've not personally seen that yet, but I'm not ruling it out.
I'd like to add, I have seen a little bit of an uptick in boards calling about specifically the technology aspect of what COVID has brought about. They just don't have the budget to commit to upgrade everything, to do everything on a phone, and they're really nervous about the future. And I think that is a big factor that has come into play now with COVID, and boards are really serious about, do we commit all this money and time to upgrade everything, or do we just look for a partner?
Okay, thank you guys for that. Chris, maybe one for you. In my experience over the past 2 decades as an analyst, there are some constants that repeat every M&A cycle, right? Like succession planning is a driver of M&A. But then with every new M&A cycle, there are always new wrinkles, right? New themes that weren't as prevalent in maybe the prior cycle. From your conversations, your observations, is there a new theme, maybe post-COVID, that's going to be a driver of M&A that we maybe didn't see as much of as a factor, maybe pre-COVID?
Yes. Well, I think Dan touched on it. I mean, I don't think it's unique to banking or community banking. I think it's impacted all of us. And I think the pandemic has accelerated the impact or the dislocation that technology is cutting across all industries, and particularly banking, whether it's accelerating the move to digital, diminishing the value of retail branches, because of some government policies, required government policies or needed government policies. I think, interest rates appear to be lower for longer, and that's obviously a challenge for all financial institutions. But I think it's really the amount of time, effort, and the comfort that customers are getting with technology, and the requirement of all institutions to invest and be able to meet that need. I mean, I read a statistic, which I think everybody on this call probably knows, but the top 20 banks in this country last year spent over 60 billion on technology. You can argue bigger organizations are maybe going to be a little less tight on their budgets or a little more spending, but that is an awfully big barrier for smaller institutions. And so again, I think technology is accelerating the need for smaller institutions to gain greater scale. Not that they're going to become a Bank of America or JP Morgan in size, but just to get that scale so they can spend the money or team up with a larger partner who can help them take care of their customers better and their communities.
Okay. Before we leave the topic of M&A, just a question for any of you. Coming off a down cycle, typically in the stocks, sometimes it takes a while for the private banks to kind of wrap their heads around where we are, right? The new reality. Do you guys think that it's going to take longer, maybe to see M&A pick up amongst private banks, or maybe publics buying privates, because it takes the privates, a little longer to kind of come to the new reality? Or and from the conversations you have, do private banks kind of grasp the reality of where we are, and they'll be just as big of a participant, if not more so than the public banks in this next round of M&A? For anybody who wants to take that one.
Well, I'll start
Joe?
off. I mean, I'm sorry. So I think companies of all sizes understand the burden, but I don't think that the challenge of where we are in the M&A cycle, if you're going to sell, you're thinking about selling, and maybe you're disappointed at the quote unquote day one multiple you might receive today. But I think if you were not necessarily thinking about selling 6 or 9 months ago, you're probably more inclined to wait as a private company, because you don't see that detriment in value day after day in your stock price.
Yeah, I agree. I think it just depends on where you are. If you're thinking about selling, the multiples, you're going to have to probably take a little less and hope for some upside. But if you're not in any hurry, then you'll wait and see what how it plays out.
Yeah, Joe, they're slower to react on the valuation change on the downside, not so much on the upside in general. But the counter to that is that the smaller banks have been, in my opinion, hit more dramatically by margin declines. They generally don't have much in the way of fee income, and so they're sitting there probably worth less on a relative basis than perhaps even some of those publics. So taking the right stock at the right time could be the best end result for those banks.
Sense. Hey, just pivoting maybe to the capital market side, question for Dan. Dan, with the volatility in the stocks and the depressed trading multiples that we've seen until really recently, there hasn't been any equity issuance. There's been a heck of a lot of debt issuance, right, with rates as low as they are. A lot of reasons for that. Maybe one unique feature this go around has been, I'd say, the access that very small banks have to the capital markets at really attractive rates, right? So are conditions ripe in your mind for this trend to continue for a while? And what should banks, large and small, be thinking about as they look to optimize their capital stack here going forward?
I agree. I have never seen anything like it in my career as far as the availability for smaller community banks to access the sub-debt market. It's amazing the level of, we're doing probably about 2 a week, and they're smaller ones. They're typically banks under $3 billion in assets. We have done a $100 million raise, but our deal is typically 25 million plus or minus. And the demand out there, Kade touched on it. There's not many investments in the bond area or loans where you can get a 4 to 5% yield. So community banks are investing in community bank sub-debt. We have a really good distribution network, and we're able to place it within our 600 plus balance sheet strategy clients. And it's amazing. Just anecdotally, last week we had a little $300 million bank who wanted $7 million in sub-debt, and we only had it open for about an hour and a half, and we're able to get a 4.5% coupon. It's just amazing the level of demand out there, not enough supply.
Thanks, Dan, for that. Chris, Dan touched on some of the reasons why we're seeing the explosion of the sub-debt. In your opinion, is this an attractive investment for banks to consider? And there are other factors at play here also?
No, absolutely. I mean, again, 3 months from now, we may not see this kind of demand, but we've really seen over the last even 6 or 9 months, our investors in the sub-debt market have much more become the community banks as opposed to insurance companies and money managers who traditionally played in this space. They used to be the price setters. Now it's the community banks. And I think the reason is in this economic environment, it's very tough to accumulate good earning assets. And so putting a little duration on your books at a good yield, as Dan talked about, I think makes a lot of sense. And if anything, from a diversity standpoint, I don't think you're seeing the banks go all in on this and moving all their liquidity and earning assets into this. But what they're all doing is taking, depending on the size of the bank, pockets, 25 million, 50 million, that they're allocating to this investor class. And in a perfect world, a Houston bank would buy another Houston bank's paper, but they may not have that access. So then they expand out to the state. And then before you know it, they say, well, I still want to buy 25 million worth of this paper over the next 3 months. They're going to look at other good banks, community banks, and they clearly know the model. So I think it is a good investment. Dan touched on it. You know, you're talking about equivalent to bond yields, sometimes better than bond yields, investment grade rated often, and generally business models that the community bankers all know. So it's pretty easy to figure out.
And there is a limitation. You know, the regulators only let you invest up to 25% of your equity in other banks' sub-debt. So, you know, there is some limitation as far as risk goes.
Okay. And I have to think so too, guys, coming off 08 with the, you know, the bank failures that we saw for several years after, there's not the perception this time that you'll see the same level of failures or even anywhere close. So maybe there's just the safety factor too, that people just feel more comfortable this go around than last time. Kade, question for you, just a follow-up question. With the resurgence in bank stock prices and an emerging hint of stability out there, is equity issuance back on the table, or is there still just, you know, to maybe help fund expansion, whether it be M&A or whatever else, or is it just still too much uncertainty for banks to think about issuing equity at this point, in your view?
So, Joe, short answer is no. I don't think it's so much the risk element at this point is more of a valuation, decision. You know, most of the banks have more capital than they've had. Most of them have more reserves than they've probably had ever. So I think they feel pretty good on the, capital relative to the risk on their balance sheet. But, valuations are still, very subpar compared to, by all historical standards, with the exception of the credit crisis, valuations are still low, and there's no growth, right? So banks are still making decent money now that they've mostly stopped provisioning. And so they're organically building capital. Now, there's no loan growth out there. So I expect the way a lot of banks will lever that excess capital is through M&A. And if they get one that's, fully levers their capital, you could see some offensive capital raises despite, valuation where it is today for the right opportunity. But in general, most management teams across the country are not, and boards are not, looking to go issue a lot of shares blindly without an opportunity at these valuations. Not having any, recap conversations in regards to, scared of, the loans on our books and leading to a shortfall. The other thing is, there's this big unknown of PPP, the Paycheck Protection Programs loans. Some banks, stuck their toe in the water. Some banks went all in on it. And while it generally didn't impact the regulatory capital ratios, it has impacted their tangible common equity, tangible assets. So if it's a public company we're talking about, that capital ratio is maybe artificially low. So the question is, what's going to happen? And Chris or Dan can jump in here. But what's going to happen with these PPP loans? Are all ultimately forgiven? Do they stay there? in the form of deposits? Do they move off the balance sheet? So I'm not sure anyone can accurately predict, where their TC ratio is going to be, because there's, thousands of customer decisions on what are going to happen with that, with what's come in through the Paycheck Protection Program.
Anybody else want to chime in on that? Kade, and sticking with you on this next one, moving to the new normal post-COVID, next topic. Sure. And then maybe Dan and Chris, please jump in on this also. As an analyst, and I also think I speak for a lot of investors, I was rarely in favor of seeing banks skip over geography to do deals, right? And I could back that up with data. Banks with contiguous market footprints trade at higher multiples. They perform better fundamentally than banks that don't. But now with the digital and technological advancements we've seen, this Zoom and webinar world we've all gotten used to, I'm starting to rethink that a little bit. Do you guys, well, starting with you, Kade, do you agree? Is it easier now in a post-COVID world, you think, to play geographic hopscotch with M&A or organic growth, and do we see more of it, do you think, as we move forward?
So it might be easier. Does it create more franchise value and not take on too much risk? To me, those are the bigger questions. I mean, operationally, I think you could more effectively manage. Most all of us have worked from home quite some time the last 8 months here. But Joe, let's go back pre-COVID. In general, I was not a fan of skipping geography on the state level. Now, within Texas, if you're a smaller town, low loan to deposit ratio bank, couldn't really make any more loans in your geography. Say you're in a town of 20,000 people, how many towns of that size or smaller would you skip over to go to, a major metropolitan area, within a state, moving to a better demographic, better growth area market? I think that definitely creates franchise value. So as long as you get the right first producers, then customers. I could look the other way. Again, pre-COVID, a lot of metropolitan banks were bumping up to or over the 100% loan deposit ratio, and they would skip quite a bit of geography within the state to enhance their liquidity and buy good core deposit bases. So I think both of those plays, looking for loans or looking for deposits, will continue within states and contiguous geographies. The only time I really saw a lot of shotgun approach that you kind of hinted at, Joe, would be FDIC deals. I think the financial incentive in the credit crisis, I saw more state border skipping, if you will, given the loss protection and the economics of those transactions. Look, I think it's the technology, kind of what I started with. It's more of an operating enhancement than a strategic enhancement. That's my opinion today. That very well could change here in a year or more, but I think you've got to keep your franchise where it makes sense on the map. You can manage it, and it makes sense not only for you as an independent company, but if you're ultimately looking to sell, does it make sense for your potential buyers?
Did anyone have a different opinion on it? Thanks, Kade. Did anyone have a different opinion there, or are you guys in agreement with?
Well, I kind of have an alternative. I think it depends on the bank. If they're really into technology and retail, then they can skip and use the iPhone to do banking. But at some point, we're going to get back out and talk to customers, and if they're a really client-focused bank and the loans that they're doing can't be securitized through some kind of fintech, then hopping over states, it's going to be more risky because you need those people, those customer-facing lenders that are out there generating the loans. So it kind of depends on the bank and if it matches their business strategy.
And if I could just add one other thing, which I don't think Kade or Dan would disagree with, but given that this is a Southwestern focus, and we probably, the three of us, spend most of our time in the state of Texas, given its size, both the number of institutions, population, growth. But the reality of it is, and you see this with PNC buying the BBVA assets, I mean, they jumped over a lot. Now they're a bigger organization. They're not a small community bank. They've always been strong technologically, but I think people who are not yet of scale and size in the state of Texas, whether they do it through acquisitions or through technology, are going to jump to get more to the state of Texas, because there are few sizable, scalable opportunities that are actionable in the state. And yet, if you want to get to the state, there are a number of states between wherever you are and Texas that may not have the same demographics. And there, I do think people on the inbound will be more aggressive or less worried about jumping over geographies to come to the state of Texas.
Yeah, Chris, I agree, especially the point you made. The larger you are, the more likely it is that you could skip more states is the way I would think about it. In this, low to no growth environment that we're probably going to be in for some period of time here, I think that makes spots like Texas more sought after. Texas has always had, better growth than a lot of the states in the country. But if your state is decline, I'd be more inclined to skip all the way across the country if my state and all the contiguous states were shrinking in loan opportunities, but also population. So, you're starting to see a real population migration, and Texas is getting, its fair share of that in-migration. So it could, coming out of this in the next couple of years, you could see Texas stand out and be a much higher growth than it had been even in pre-COVID.
Sticking with the new normal post-COVID topic, the point earlier I thought was interesting about PPP and TCE and the unique aspects around that. Dan, a question for you on modeling for deals. The period of uncertainty we're in, you've got record levels of excess liquidity. Who knows how long that's going to be with us. You've got policy uncertainty around tax rates. The decision could change on that depending on what happens in early January in Georgia. You've got PPP, which we've talked about, and the timing on forgiveness and what that looks like. So with that backdrop, for banks that are looking at targets, what does the modeling look like? Like, do you guys have parallel sets of assumptions that you use when you advise banks? Do you look past all of this? I don't call it noise. There's a lot of it. Do you look to a more normal environment? 2020, late 21, early 22, or is this just one of the factors that's holding us back from seeing M&A at this point, because there just is too much uncertainty on what things look like going forward?
Yeah, I think we all start with some set of assumptions, but as I said before, I'm a little bit nervous about the loan books in 2021 if things go south. And so I really want the exam cycle to work through for both the buyer and the seller. If you're taking someone's stock, you need to do a lot of reverse due diligence. If you're buying somebody, whether it's cash or stock, you got to do a lot of due diligence. So I'd rather have the examiners go in there and be the bad guy and mark down loans than me as a buyer. If I'm in there second after the examiner, then they're probably more realistic about, their credits, and then we can start making assumptions on models and things. So I think from a model perspective, it's just going to take longer to make sure we know what you're buying and what you're investing in if you're taking someone's stock.
Joe, I don't think there's ever been a more complicated time on projecting future earnings than in the last decade. You as a research analyst did it down to the penny. We're trying to get pretty close, on our side too. But we struggle as third parties, but the management teams and boards, are really having a difficult time. Most of them are having much wider guesses today than they would have felt comfortable with in the past.
And I agree. You can't put deposits much lower than they are, and you got asset yields coming down. And Kade mentioned it earlier. Net interest margins are just getting crushed right now, and until interest rates rise, it's going to continue to go down. It's hard.
Well, it's all risk mitigation, right? If you're a buyer or you're a seller. So there's always walls of worry that buyers have to get through, but in this time, there's all still uncertainties. So the deals we've worked on that have been announced and that I think we'll get it to close, some have closed, have really been where the parties knew each other very well. They tended to be an exchange of stock as opposed to an outright acquisition, or the party, like when First Citizens bought CIT, enormous amount of due diligence time went into that. And Kade touched on it with the deal his firm announced earlier. I mean, Dan Rollins is a very smart guy, and he spent time he obviously was interested in the business for a lot of good reasons, but he was also more uncertain at the start of the pandemic, as we all were, as we've all gotten a little more visibility, clarity, or hopefulness about the future. He probably got more comfortable. There was more time spent. I don't know what ongoing discussions there might have been over the last 6 months, but I think as we continue to get more clarity in the economy, the healthcare outcomes, the government policy, I think people will be more aggressive. And Dan's right. The modeling, we have our templates, we have our guideposts, but the reality of it is the buyers or the sellers, when we're thinking about this, have to be somewhat realistic and probably, at least initially, even at this point, are more conservative.
Yeah, Joe, there's normally one round of diligence. I feel comfortable saying this is out in their investor deck, but to Chris's point, Bancorp South did 3 rounds of diligence on National United leading up to the announcement. Over the time period from February until last week, the world changed 2 or 3 times, right? So had to come back and reassess.
Sounds like the overriding theme here, correct me if I'm wrong, guys, that I'm hearing from the 3 of you, is that even though we've been in this for 8, 9 months now, there's not a lot yet of the, hey, this is what's happened over these past 8 months. This is kind of what we think the world's going to look like. Why don't we start talking? It's still more just tying up loose ends from things that were happening pre-COVID. And then Chris, you made a point, so question on that. Chris, you made a point earlier that first quarter announcements will be coming from an M&A standpoint. Are those still continuations of year ago discussions, or some of those announcements that you're looking to, some things that may have started percolating July, August, September timeframe?
So I think it's both. And I don't think we're talking about 1 or 2 or 5. I mean, you're seeing the number of deals that, we are announcing bank M&A deals this quarter, last quarter, second quarter of 2020, when we really all felt the brunt of the onset of the pandemic was, I think there were 9 deals announced. And I would bet they were probably announced early in the second quarter. But it is picking up. And I think it's just in that, for all the reasons, I don't know if we're going to spend time there, but for all the reasons we've kind of touched on around there is a need, and there has been an ongoing consolidation in the industry. Pre-pandemic, 250 to 300 banks a year were being sold. I don't think that's going to stop. It may take us a while to get back to that run rate, if that's truly the run rate, but all the factors, the need for scale, the need for investment in technology, in a low growth environment, finding ways to drop income to the bottom line. I think that's inevitable. And that's why my initial comments at the start of this was, I think it's back end weighted, but to your point, Joe, just to put a fine point on it, I think there still are some moving pieces that if you're a bank owner, board, CEO, and especially if you're public, and you're probably not trading much above tangible books, there's certainly some notable exceptions to that. Why would I go and really go over my ski tops to buy something or spend a lot of time on it? I can buy my own shares, and I'm probably getting at least near term, a better risk reward. That will evolve, but I think that's where we are now. And the more share repurchase, and assuming we get through CCAR and the bigger banks are given a little more flexibility, that'll trickle down to the smaller banks. And over time, hopefully, again, valuations expand, people get more confident, and CEOs, because they want to buy or they want to sell, there'll be a lot more activity.
Chris, last one for me before I turn it over to Brian. What does the Gold Star Bank look like in a post-COVID environment? And on the flip side, what are the characteristics of the management team that you're looking at that make them, supremely well positioned for what we're going to see going forward? And then on the flip side, for any of you guys, what are the attributes that make you say, or make you maybe want to, or lead you to advise the management team of that particular bank to consider other options than independence?
I don't know that the pandemic has changed what I consider gold star standards, but maybe it has made it clearer how important those are. So obviously there's management. You better be very good on credit. If you've had credit issues, you can see how that both impacts your organization, but probably impacts your valuation because you're just further away from, in a tough environment running at full. Capital, all things that generally people are. And then all the general things about running the business and having a future view of, I'm going to continue to grow. I'm going to find ways to drop more income on the bottom line. I'm not going to worry about, the low interest rates or the costs I have to spend. I'm going to find a way to get through it. And the flip side is, again, if you're a bank that has had credit issues, or I'll call it broadly management, not that the management is bad, but maybe you have a succession issue, you don't have enough depth. Those are all things I think that put you on the have not category in my mind, or the non-gold star.
Yeah, Joe, I'll add on to that. If you're a bank in a smaller market, low loan to deposit ratio, no fee income, no management succession, don't pay a dividend, no shareholder liquidity, your margin's getting crushed. You don't have any defense. Your market's not going to grow. You're probably not going to take a risk buying bank sub debt all over the country. If you're a small town conservative bank, you might buy some peers in the area, but you're going to be limited, at some point, per Dan's comment. So I think those are the banks that they're good businesses. They're just really stressed right now. And if they have the wherewithal at the board level and the management level to ride this out, it'll be fine. But I think a lot of banks with those characteristics are likely going to be in the next round of sellers. And I won't put a time frame on that, but over the next couple of years.
Yeah, I agree with Kade. I mean, those were issues that were there before COVID, and they're just exacerbated with COVID. I think specific to Texas, I mean, we still have over 400 bank charters. When I got out of college in '86, the banking industry was in the toilet. I couldn't get a banking job if my life depended on it. So I'm mid-50s right now, and it's hard to find bankers in Texas in their mid-50s because banks weren't hiring then. So you have a lot of 60-year-old bankers running banks, 70-year-old board members, and then 40-year-old bankers. Are they going to trust the 40-year-old bankers to take over the bank? A lot of them aren't, and it's just the way it is in Texas because the economy back in the late 80s, early 90s, not a lot of people went into banking.
And that's actually a good spot to transition over to talent. You're right. There are some talent gaps that have happened over the years, and just as things were starting to get back, a pandemic hits us again. So you wonder if banking over the next 10, 15 years, there's going to be another gap in talent. But obviously, talent is what Travillian is known for. It's what I'm passionate about. It's our domain. So my first question is to Kade. Kade, for banks thinking about aggressive expansion beyond COVID, what are the characteristics talent-wise in terms of people and their skill set and experience that you would recommend having on staff to help pursue their expansion plans in this new normal environment?
Couple questions there in one, Brian. So I'll address later the banks that were already growing pre-COVID and want to continue, or those that now feel the pressures, from declining revenue, that feel they need to grow to increase scale and efficiency. It's kind of almost two different groups of banks, if you will. But it's more your area than mine on the talent side. But from what I see in talking to bank CEOs and management teams, all day, every day, banking is not getting any easier. It's not getting any less intense. Cost of technology continues to outpace every other expense. The regulatory environment is likely not to get any easier than it had been the prior 4 years. So before you talk about growing, there are already plenty of challenges to continue to run the business you have today. So that leads me to the point of, if you are going to grow, I think you need to make sure you've got the right team to operate your business as it is today. Because looking to expand through hiring people, opening de novos, or then even more importantly, M&A takes a lot of time. And it's adding another job on top of their already busy job. If it's a CEO level, generally our clients, it's the CEO that's tasked with spearheading the growth, or at least the ways to grow. Maybe not having every banker launch out there on the lender side, but at least on the M&A side, it's generally spearheaded by the CEO. Now, if they have not been acquirers in the past, it's not easy to get a deal sourced and announced, but the real critical element is making sure it's integrated properly. So if you were a bank we're not growing that much, or not in the M&A business, or a lot of new de novos pre-COVID, you think, well, now I feel the pressure. I'd say you got to have your operating team running the bank while you're out on the road or meeting people. And you need to make sure if you do find a deal, you have the right team to properly integrate that. You don't, there's gonna be a lot of eyes on the proper integration from the regulatory perspective in this environment where credit's still somewhat of a concern. So I think you need to make sure you've got the right team, and maybe a CEO would look to delegate some previous responsibilities if they're looking at, you characterize it as an aggressive expansion plan. So if you're going to say aggressive, I think you need to, create some time for yourself. As far as the operating side, I think a very tech savvy COO, or perhaps adding a chief technology officer, could be worth consideration. Brian, I don't know if y'all do much in the way of those searches, but not a lot of our clients have a chief technology officer, or they do, but they're kind of behind the scenes. So that could be more of a spotlight position in the next, let's just say the next decade. I'll kind of look further out. And then also I'll go all the way down the branch level from the talent side. The days of a 10,000 square foot branch with 15 employees sitting there, all doing very different responsibilities. It's not done, but it's going to change a lot. Branches are shrinking dramatically in size. A lot of I'd say more larger community banks to regional banks are cutting 15% of their branch network pretty consistently over the last few months. But specifically on the talent side, I would rather have 5 individuals in the branch that can wear multiple hats than 15 all standing around doing different things. Even if I had to pay those 5, a little bit more to attract a little better talent at the branch level. And I think all of our clients are looking under every rock they can right now for efficiencies. I think when the pandemic hit, they said, look, we know our revenues are going to get crushed. We're not yet in this aggressive growth stage, as the question was. So what can we do first? And it's get more efficient. And so that's really what I saw was the first wave of, let's get more efficient. Let's think about staffing on the talent side. And then I think as we get past 2020 vaccines, out and working, I think at that point you'll get more into the aggressive expansion to cure the revenue shortfall. And I think that's when the talent drive is probably going to become more apparent.
That's a great response. A lot to unpack there with, universal bankers and also technology. And you bet, the CTO, CIO role, that's something we're seeing very prevalent. We're having a lot of advisory conversations. Do banks need a CTO? Can they help promote their head of IT? Can they partner with a consultant? Should they get someone who's a little more innovative around what they already have? And these are things that we're helping our client banks with. Moving
Brian,
on.
does the average, what size, just a question for you, what size banks have a chief technology officer, and where do you see it making sense?
Yeah, if you look at a bank under $1 billion, you generally will have a head of IT, maybe under 500 million. CTO kind of emerges right around that, that 500 million mark. And then once it's past $1 billion or on, there's CTOs and CIOs. CIOs are more on the information security and some of the nuts and bolts, and CTOs are a little bit more innovative. But a lot of banks are a little bit different about that. So we're helping banks understand what they need. Sometimes it's just a little bit of mentoring, and you can actually bring someone along and not have to recruit. But that's a good question for me. I appreciate you asking it, Kade.
Well, I haven't had that conversation with clients, so I figured there's someone on the line that would like to know.
Certainly, yeah. Well, for the sake of time, I'm going to keep moving on here. Dan, you actually were one of the first to mention technology, so I would kind of assume that might be in your response here. But are you anticipating any non-M&A related musical chairs, within executive teams or other teams for banks that you follow?
Non-M&A, I think, well, Kade touched on it. Everyone's looking for efficiencies because with margins, I mean, there's only 2 or 3 drivers you can help, generate net income. Can you lower the deposit costs? No. Yields are going down. So then you got to look at staffing. And I could see more people taking on more responsibility, yeah, and that would help with musical chairs. And then I already mentioned succession planning. It's just hard to begin with just because the lack of talent. There's still some de novos opening up, trying to hire teams from other banks. I mean, it's still really, really competitive, especially in the metro markets, to find good lenders. In Houston, I hear about it all the time. I get inbound calls from people all the time looking for talent.
Appreciate that, Dan. I'm gonna actually skip ahead to succession planning, but I'll actually give I'll see if Chris wants to jump in on this. But this question's for Kade. Obviously, succession planning is one of the hottest topics in the boardroom. You guys have all mentioned it a few times in this conversation. So what's been your experience in observing the banks that have managed this process well versus those that have struggled? What are the commonalities, both positive and negative, that you've seen?
So running along here on time, so I'll be very brief. It's the number one reason most banks end up selling. I'd say second or equal would be just shareholder liquidity needs or desires. But I think that the 2 things I see are identify the candidates early and allow time to get them additional exposure around the bank, both to your internal to your bank team, but also to third parties that have a real stake, whether it's regulators, clearly your shareholders. I think the banks I've seen that do it the best at the community bank level, they identify the person and kind of make it well known that that's who will take over, versus a 3 or 4 person race and it gets competitive and at the end they pick 1 and 2 quit. That just, you see that at the big banks. I don't generally see that at the community banks. So I think it's a real issue. Start early, give that individual kind of notoriety and responsibility earlier rather than later. One other thing is, seen to work quite a bit, is a kind of an outgoing CEO transitioning more to an executive chair, giving additional responsibility, kind of downstreaming that.
Chris, it looked like you wanted to mention something.
No, I think that's a good summary. I think it's very difficult, especially with private companies where there's more personal relationships among board members, and for these successions to work well. It happens, but I think it is very difficult. I think the public, just by dint of governance issues and mandated issues, it tends to move along. But I think it's just a very difficult topic. And to Kade's point, it has to be well planned out.
Sure. So I wanted to actually jump into the Southwest regional outlook, because you all cover the Southwestern region. Obviously, there's a lot more to talk about with succession, but I'd like to kind of focus on your geographies here. Dan, we've talked so far about all these things that are pretty national in scope. Obviously, how has the Southwest economy fared relative to the broader economy through COVID? And as we emerge from it, what are some of the unique considerations Southwestern banks facing Southwestern banks relative to banks elsewhere?
Well, obviously, the energy industry affects the Houston area and Texas a lot. So there's some concern there. None of the small community banks have direct exposure, but everyone in Texas has indirect exposure at some form or fashion. So you got to monitor that. And that's just another complexity of what banks are having to deal with. And I know the regulators are starting to ask questions about it. So, I think the demographics of the area are great. Kade mentioned a lot of people moving to Texas, a lot of companies moving to Texas. That's still happening. We're getting them more and more diversified, less dependent on energy. But energy is still the elephant in the room, and so we can't just ignore it. But all in all, I think if you look, Texas does have upward trajectory, so it should be good long term as long as we're aware of the risk.
And sticking on the energy, Chris, for you, how does energy exposure on a bank's balance sheet in terms of concentration, type, et cetera, factor into these new normal operating environments and end M&A? Is it a hindrance? Is it a value play? And how should acquirers and investors and targets looking to be in better position themselves be thinking about this as we move forward?
Well, my experience is, other than people like Cullen Frost or Bank of Oklahoma, who have significant decades-long experience in the area, most of the comparable or smaller banks in the region are fading away from being lenders. I mean, to Dan's point, if you're in the Southwest, you're exposed. And so as a part of loan growth, you may have extant customers. But I think for the most part, you're going to see most of the banks, public or private, even if they're exposed, have de minimis exposure to the energy sector. And related to that, and we all know this, other than financials, the sector that's been hurt the most or has traded the worst is the energy sector. And I think that they have more long-term structural issues. And with the new administration, some of the plans, I think the energy lending that may go on may be more related to renewables as opposed to fossil fuels going forward. I just don't see the amount of cost that it takes to have a viable energy lending for smaller banks, unless again, they're the size and expertise of like a Frost or a BOK.
Pivot into fintech maybe real quick. Chris, let's assume you're representing an acquirer that is digitally and technologically more advanced relative to peers. Would you say it's more difficult to acquire an integrated bank that's behind the curve in that area? Is there just too much heavy lifting on the part of the digitally and technologically advanced management team? Or on the flip side, is it maybe more attractive because the acquirer has been through the process themselves and maybe there are easy cost saves to be had in an environment where, expense saves are pretty valuable? How would you respond to that? And how would you advise your clients in that regard, I should say?
Yeah, so I haven't really seen such a gap between the buyer and the seller's technological advantage. I do believe that it's easier to change technology than to downsize personnel or shutter branches. So I do believe over time it will make it easier, but I think the buyers are making just valuation discussions. If it costs them X more to buy a technologically inferior company, they'll just factor that in the pricing. So my general view is there's been gaps, but probably more gaps about a north of $10 billion company buying a south of $10 billion company who has not been through the regulatory scrutiny and the standards is probably a bigger issue to me, and maybe related to that is technology, but I don't think it dissuades buyers from buying, or it just gets translated into valuation.
Kade or Dan, anything to add to that?
Yeah, Joe, I haven't spent much time thinking about it. And like Chris, I've not seen a large gap. I guess I would quickly, thinking through this real time, put it in the further behind the target is on the technology side, likely the more cost savings. The more cost savings there are, and the quicker you can get those cost savings, because it's pretty quick to change technology. So I see it perhaps as an opportunity from the buyer.
Great.
I think that's about all the time we have today, guys. I'd like to thank our panelists, Chris, Kade, and Dan, for participating today. It's been enlightening. And with that, I will turn it back over to you, Brian.
Yeah, thanks, Joe. And thanks again. Appreciate it, Chris, Kade, and Dan. Much appreciate your time and your contributions here. To all of our viewers, thank you as well for joining us. Just an FYI, this video will be up on Travillian's YouTube and LinkedIn pages over the coming days. So if you'd like to rewatch or share with people from your network, please do. And I'd love it if you could follow us on said social media channels to stay abreast of our new content, which is published each week. Also, for banks that are interested in our services, please feel free to reach out to me. My information is right there on your screen. And, lastly, I'll just say happy holidays to everyone. Thanks so much for joining us and have a great afternoon.
Thank you, Brian. Thank you, Joe.
Thank you.
Thank you, guys.